In 1887, I watched a cowboy named Jed lose his whole spread, 500 acres of good prairie, over a single piece of bank paper. That boy thought he was sitting pretty, 'cause the bankers said his debt was as good as gold. But when the market turned and the price of beef dropped, that gold turned into smoke. Jed's land got sold for cents on the dollar, and he rode out of Dodge with nothing but dust in his pockets. Now it's 2026, and folks just like Jed are still losing everything. Only this time, they don't even see it happen. They check their phones, thinking their bank app means they own something. They buy stocks, ETFs, tokens, all paper promises wrapped in shiny screens. But don't be fooled, hoss. Them ain't assets you can touch. The moment the system shutters for a weekend, or the market freezes, you'll find out what Jed did. You don't really own nothing. See, back in my day, a man's money jingled when he walked. A $20 coin had 20 real dollars of gold. You could feel the weight. Today, that same ounce of gold is worth over $2,000, while your dollar buys you less than a candy bar compared to 1900. That's a century of theft hidden under fancy talk, inflation, policy, growth. What they don't tell you is, it's the same old trickin' game, just played with faster horses. Folks think they're playing it smart, saving in the bank, investing in funds, trusting the system. The banker feller says, "Don't worry, your deposit's insured." The financial channel says, "Just keep dollar cost averaging." And most of you do. Believing safety comes from the paper trail. But let me ask you one thing. When was the last time you held your wealth? Not saw it, held it. That silence you feel right now? That's the same silence Jed heard the day the auctioneer called his name. Here's the truth most finance fellers won't tell you. When your money sits in banks or digital funds, it's not your money. It's the bank's liability. They owe it to you, but they don't have to give it to you till they want to. If 1% of depositors ask for their cash right now, the whole rope snaps. Same way a stampede breaks a fence. Banks lend your dollars 10 times over, hoping nobody calls their bluff. And that's why every inflation cycle feels like deja vu. The first hit comes quiet, prices up 3%, maybe 5%. Then one day it spikes 10%, and everyone panics, selling the same paper they thought was safe. By then, it's too late. History shows, each time the dollar slips by half, it never climbs back. The math don't lie. From 1900 to now, the US dollar's lost over 98% of its purchasing power. Imagine saving your whole life, only to find out the safe dollar died while you slept. I seen this pattern before, boy. Different time, same bait. Folks trading gold and cattle for paper promises, believing the banker's smile, losing what they built. In 1900, the government took the gold. In 2026, they'll take the control. One tap, one policy, one central bank digital currency away. I ain't telling you to panic. I'm telling you to listen. The same wind that blew through Dodge City still blows today, only now it hums through fiber cables. You can't smell it yet, but storm's coming. And if you ain't holding something real when it hits, you're riding Jed's trail all over again. In 1896, I was riding through Leadville, Colorado, when I met a banker named Porter. Wore a silk vest and a grin sharper than a bowie knife. He didn't own no cattle, no land, no gold, but somehow he owned half the town. I asked him once how that worked, and he laughed. "Nat, I don't own stuff. I own paper that says I do." That feller taught me something I ain't forgotten. The system ain't made to keep value safe. It's made to move it. From the hands that earn it to the hands that issue credit. Always has been. See, the Gold Standard Act of 1900 looked fair on the surface. Government said, "We'll back every dollar with gold." But that meant folks like Porter could trade paper backed by the government's metal, not their own. Regular folks like me had to hand in our coins, and soon enough, our backed dollars turned into I owe us. The gold ended up locked in vaults, while the paper kept flowing. Just like today's ETFs and bank accounts. You think you got gold, but it's stacked somewhere else under someone else's name. Fast forward a century, and the game just got slicker. Instead of rail wagons, you've got data cables. Instead of paper notes, it's digits. But the structure's the same. About 10% in real reserves, 90% in promises. Banks lend out your deposit 10 times over through fractional reserve banking. And the Federal Reserve decides how fast that herd runs by changing interest rates and liquidity. Now let's talk real, folks. 2026 numbers. The average American household saves less than 5% of their income. 65% live paycheck to paycheck. That means the system depends on you spending and borrowing. If everybody started saving gold or cashing out of ETFs, the carousel would stop, and the bankers hate a stalling carousel. So they built the rules to make sure it never stops. Inflation eats your dollars, taxes bite your capital gains, and negative real interest rates force your money to keep running in circles. That's why standard advice don't work. Just keep your money in the S&P 500. Sure, that index goes up, mostly because the dollar's worth less every year. Keep it in the bank. Fine, until the bank locks withdrawals or a bail-in eats your savings like in Cyprus, 2013. Buy gold ETFs. Maybe, but you'll never see that gold, and if things go south, the contract says you get cash equivalent, not the metal. I seen this story in 1883 when a cattle syndicate defaulted. The paper holders got promises, the insiders got land. Same plot, new actors. 2008, folks owned mortgage-backed securities that turned out to be nothing but wind. 2026, folks own digital assets backed by algorithms, not assets. Different saddle, same saddle sores. Truth is, the structure's built on behavior. Most people don't want to think long-term. They chase short profit and comfort. The bankers know that. They feed it. You earn 5%, inflation's 6%, but you're too tired to notice. That's how it's designed. Not by accident, by policy. The system needs borrowers, not owners. The gold standard didn't end the gold rush. It nationalized it. And now, CBDCs and regulated ETFs are fixing to do the same. They call it efficient, secure, modern finance. I call it what I saw back in Leadville, a slick vest on a thief. I ain't telling you to burn the banks, not yet, but you'd better start thinking like a man who knows where his cattle graze, 'cause soon the corral's gonna close and the federal brand will be on every steer. In 1883, outside Abilene, I watched 3 ranchers ride into ruin before spring thaw. Each had land, cattle, savings, but each made the same fool mistake. They trusted paper more than dirt. One mortgaged his acres for expansion, one lent gold to a banker for dividends, and the last hoarded dollars instead of grain. Come drought, all 3 stood broke. Their cows starved, their cash turned worthless, and the banker rode off richer. 140 years later, folks still play that same hand. The hats are different, but the math ain't. I see people letting 3 bad habits gut their future. Mistake 1, saving what melts. Most folks stack paper that burns faster than campfire wood. Inflation eats about 3 to 5% a year on paper, but right now, it's closer to 6%. That means a dollar today loses half its power in roughly 12 years. You start with $100,000 in a safe account. In 10 years, it buys $55,000 worth of goods. 20 years later, it's worth less than $30,000 in real terms. Same trap old Hank fell into, holding greenbacks after the panic of 1893. Didn't lose his dollars, just lost what they could buy. Mistake 2. Relying on debt to feel rich. Folks think if they can manage their loans, they're winning. But that's like a rancher saying he's in control 'cause he ain't trampled yet. In 2026, the average American carries over $60,000 in total debt: mortgages, credit cards, car loans. At 7% to 8% interest, that debt doubles in roughly 10 years if you ain't paying principal steady. You might own a house on paper, but the bank owns the deed till your beard's gray. I seen ranchers live that way, dying with land they never truly owned. Mistake 3. Investin' blind. They dump money into ETFs, crypto, or diversified portfolios without knowing what backs them. They see the chart go up and call it wealth. Truth is, they're renting numbers from fund managers. When the market drops 20%, they panic and sell low. Same way Jed sold his herd for pennies in the drought. Over 20 years, the real winners ain't the traders, it's the issuers, the ones who take a fee no matter which way the cattle run. Mistake 4. Trusting the system to fix itself. Folks believe the government or new tech will make savings safe. CBDCs, policy rates, tax credits. That's a comfort lie. Every 20-year stretch proves it. 1900 to 1920, the dollar fell by 45%. 1971 to 1991 by 60%. 2000 to 2020 by 34%. The pattern don't break, it compounds. Each generation hands its children less value in the same paper. I tell folks this plain: your problem ain't income, it's choice. I've met men earning $40,000 who built quiet empires because they owned real things: land, tools, gold, businesses. And I've seen six-figure city slickers stay broke, strapped to payments, bragging about credit scores while their net worth sinks below zero. Time don't reward effort. It rewards ownership. So look 10 years out, hoss. If your dollars keep earning 5% while losing 6% to inflation, you ain't saving, you're sinking. 20 years from now, most retirees will outlive their savings by a decade, just like ranchers outlived their cattle herds after a bad season. I've ridden through too many busts to count, and every time the talk's the same. This time's different. It never is. The storm changes, but the fence posts break the same way. And when it does, the fellers sitting on paper will be looking for the ones holding something real to trade with. In 1899, when the banks started talking fancy about the new gold standard, I knew trouble was brewing. Too many men bragged how the government would keep their gold safe. Me, I took my nuggets, saddled my hoss, and buried him where even the sheriff couldn't sniff. Folks called me paranoid. 10 years later, those same folks were trading notes for bread, while my gold still shined under prairie dirt. That's when I learned there's safety in what you hold, not what you're told. Now, I ain't saying you gotta dig holes in the backyard. Times changed. But the system's the same. It runs on paper promises, and a man must build a plan that don't depend on 'em. Here's how I ride my herd these days. Been testing this way since before the internet had dust on it. Step 1. Keep 1/3 in hard assets. That means things you can touch: Gold, silver, land, equipment, even a small business that makes something real. The logic's simple. These don't vanish when the grid hiccups or the policy changes. When a crisis hits, physical value keeps trading. Gold's purchasing powers held steady for 5,000 years. 1 ounce bought a good suit in 1900, same as today. Hard assets beat inflation because they are the measure of value. Step 2. 1/3 in working capital. This ain't lazy cash sitting in a bank. It's your liquidity, what lets you act quick when opportunity rides by. Keep enough to cover 6 to 12 months of expenses, split between small local banks or credit unions, not just one brand-name giant. Spread it, like separating cattle herds across pastures. That way, if one gate closes, the other's still open. And don't leave it all in fiat. Use digital wallets with private control, or other stores you can move fast. Step 3. 1/3 in income producers. That includes dividend stocks, rental property, small partnerships, or side businesses. The key word is cash flow. In 1880, my cattle fed me even when prices were low. Same principle now. You don't eat net worth, you eat cash flow. If your assets pay you monthly, inflation wounds are slower to bleed you out. The mechanic behind it. Each bucket feeds the other. Your hard assets protect value, your working capital keeps you agile, and your income producers grow your base. Too much of any one and you're off balance. Too much paper and you're stuck. Too much metal and you can't move fast. The rancher's secret ain't just diversification, it's purpose in placement. Every dollar's a cowboy. It either guards the fort, grazes the field, or rides out to earn. Why's this stable? 'Cause it don't rely on predictions, it rides on control. Markets can fall 50%, banks can freeze withdrawals, but land don't disappear, gold don't default, and businesses that solve real problems keep selling. Over 15-year cycles, portfolios balanced this way have outpaced inflation by 3 to 5% annually, even through recessions. Not the highest returns, but the steadiest saddle I ever rode. And the most important part, no debt on essentials. Loans are fine for investments that pay themselves off, never for livin'. In ranch terms, borrow to buy cattle that breed, not whiskey that burns. If it don't produce, it don't deserve debt. That's my system, plain and time-tested. 1/3 touchable, 1/3 usable, 1/3 earnin'. Balanced, simple, and near bulletproof even when bankers and tech fellers start fancy talking about digital resets. Of course, there's one more step. What to do next decade when the government comes knocking again for control. And that, hoss, that's the ride we'll take next. I've seen gold rushes, bank runs, and crashes. They all looked different, sounded fancy, but ended the same. The unprepared lost their freedom first, their money second, their peace last. Don't make that your trail, hoss. Here's how to ride smart through the storm. Year 1. Build your base. You can't shoot straight with shaky hands. Start by cleaning your debts, one loan at a time, smallest first if it keeps you moving. Cut expenses by 10 to 15%. That's your first raise. Then, split what you save using the rancher's thirds. 1/3 hard assets, 1/3 liquid capital, 1/3 income producers. Buy your first ounce of gold or silver. Not much, just enough to feel it. That weight in your palm will change how you see every digital dollar. Year 5. Build your fence. By now, your foundation's steady. Use these years to make your wealth defensible. Consolidate your income streams. Rentals, side trades, online work, or freelance skills that aren't tied to a single boss. Reinvest your profits into what lasts. Land, equipment, reliable companies that pay you while you sleep. Build redundancy. 2 banks, 2 wallets, 2 skills. If one gate shuts, you still ride through another. By year 5, your goal ain't luxury, it's control. The man with steady cash flow and no desperate debts sleeps better than the feller with a sports car and a banker chain around his neck. Let your lifestyle grow slower than your assets. That gap buys freedom. Most won't do it. They'll call you old-fashioned. You just tip your hat and keep riding. Year 10. Become unshakable. By now, you should own what you stand on, literally or financially. Land, metals, businesses, or digital systems you fully control. At this stage, your money works more than you do. You don't chase yield, you tend your herd. The numbers? If your income grows 5% a year and you're spending only 2%, your surplus doubles every 14 years. Compound that, and in 10 years, you'll have 50 to 70% higher net worth, even through mild inflation. But what matters more ain't the math, it's the mindset. You'll walk into any bank, policy shift, or CBDC rollout, knowing your livelihood don't depend on their switches. Right now, what to do today? Don't wait for permission, headlines, or perfect timing. Act small but true. Withdraw a little digital comfort and replace it with real value. Learn one new skill that feeds or pays you. Set your accounts like fence posts, sturdy, spread out, and watched regular. Track your net worth monthly. Aim to grow ownership, not balance sheets. Ain't no man ever got rich by wishin'. It's built, month by month, same as mending fences before the storm. You won't see progress fast, but you'll feel it. Your nights'll get quieter, your breath steadier, 'cause you're owning your trail again. I won't lie, partner. The next 10 years'll test every fool and every wise man alike. Digital dollars, stricter laws, faster crashes. But systems only scare men who don't have one of their own. So here's mine, plain and final. Own what's real. Protect what pays you. Keep debts short and freedom long. Do that, and when the dust settles, whether in 2036 or the next century, you won't just survive. You'll still be standing by your fire, just like me, with something that no banker, sheriff, or algorithm can take away.